Here's today's Money Metals Minute, brought to you by MoneyMetals.com. Despite headwinds, including opposition from both presidential candidates, President Obama plans to promote the Trans-Pacific Partnership Trade Agreement today at the White House. He's invited a variety of political and business leaders. The guests include Ohio Governor John Kasich and former New York Mayor Michael Bloomberg. Stocks fell in early trading in Europe today, led by banks as Deutsche Bank shares tumbled following the news that the U.S. Justice Department is seeking a $14 billion settlement over its dealings in mortgage-backed securities before the '08 crisis. Asian trading was light. Now here's a special report from Mike Gleason of Money Metals Exchange.
It is my privilege now to be joined by Michael Pento, president and founder of Pento Portfolio Strategies and author of the book, The Coming Bond Market Collapse: How to Survive the Demise of the U.S. Debt Market. Michael is a money manager who ascribes to the Austrian School of Economics and has been a regular guest on CNBC, Bloomberg, and Fox Business News, among others. You've written a book about the coming bond market collapse, and I want to get your comments on that market here. We continue to see bond prices holding strong and even rallying. Central banks have been huge buyers, but it appears even the private sector can't get enough of them. Investors are taking bonds with negative yield in many cases, and I've seen reports that offerings have even been oversubscribed. Has the ongoing strength in bonds surprised you, and have you revised any of your thinking on the dire predictions about the bond market? Because I mean, there is an argument out there, Michael, that the central banks can continue to buy bonds with newly created electronic money until the moment the electricity goes out.
No, well, they certainly can, and I wrote the book in 2013. I never expected that yields would go into negative territory, so I was prescient. I was definitely ahead of the curve, calling this a bond bubble when nobody else was calling this a bond bubble. But what has occurred, basically, quite simply, is that the bond bubble is more elastic than I thought and has gotten much, much bigger. Look at the amount of global debt. Global debt right now is $230 trillion, up $60 trillion since 2007. 300%. That is 300% of global GDP. Now, the U.S. debt is 350% of GDP. Now, the average ratio of U.S. debt to GDP is 150%. And that existed for decade after decade after decade prior to going off the gold standard in 1971. So we went from 150%, which is sort of the average, the normal, to 350% debt to GDP. And there's a massive accumulation of this debt. But by the way, this is not debt that's been taken on by, you put your savings in the bank and you have a robust GDP growth, you save a little money, and that money is loaned out to the private sector for what? Capital good creation and for engendering productivity enhancements. This massive accumulation of debt isn't at all that genre. It's unproductive debt that is only made serviceable by unprecedented increases in base money supply. This is the perfect recipe for stagflation. So if you add a massive increase of unproductive debt, and I gave you the numbers, $230 trillion, totally unproductive debt going to share buybacks and hole digging and pyramid building, this debt is not going to be accompanied by any type of GDP growth. It's unserviceable unless central banks continue their torrid and unprecedented pace of quantitative easing. And to put a figure on that, there is now occurring $200 billion of quantitative easing every month. Every month. So worldwide, central bankers are engaged in QE to the tune of $200 billion a month of central bank credit creation. So if you have stagflation, no growth, and a massive and unprecedented and intractable increase in the base money supply, of course you're going to get inflation. You have to get a rapid rise in inflation. And when that occurs, you're going to have a collapse in the bond market, the likes of which we have never seen before. Let me just quickly take you to Japan. An example I love to use, 250% debt to GDP. That's just federal debt. That's not gross debt. It's just federal debt. You have an inflation target of 2%, and you have a perpetual recession, never ending. It's been going on and off since 1989. What happens when the BOJ, the Bank of Japan, successfully achieves a 2% inflation target? And don't be misled for a second. No central bank can peg an inflation target. It'll go to 2% and then keep on going. So here you are holding a Japanese JGB 10-year note going out 10 years, yielding negative, 10 basis points. Inflation is rising, going north of 2%, and you're dealing with an insolvent nation. The debt you hold is that of an insolvent, broke nation that is going to default. What are you going to do? You'll panic out of that note. You will sell that to anybody because you know that the Central Bank of Japan, the BOJ, will be getting out of the monetary monetization business. That's what I predict will happen. It's going to happen in Europe. It's going to happen in Japan. It's going to happen in the United States. And when that happens, when yields spike, it will reveal the insolvency of that global 230 trillion debt condition.
That was Michael Pento and Mike Gleason at moneymetals.com. Live prices at moneymetals.com show gold currently trading at $1,314.45 per ounce, silver as $18.96.